on the air with breaking news. This is the New York Stock Exchange. The trading day is just beginning on Wall Street, and there are fears that the Dow will drop and drop quickly, and we're already seeing that.
When the COVID-19 pandemic swept the world in early 2020, forcing economies into lockdown, equity markets crashed. In the U.S., the Dow Jones Industrial Average, which in mid-February had reached an all-time high, had, by the middle of March, given up over 35% of its value. As had become the norm on Wall Street, institutional investors immediately turned to the Federal Reserve and policymakers for help. A Pavlovian-like response conditioned through the years of escalating intervention by the central bank and open markets when things turned bad. With the closing bell of March 23rd, the markets got their wish.
And news just breaking from the Fed. Steve Leisman has it. Steve.
Joe, thanks very much. In a series of very aggressive and historic actions by the Federal Reserve that go well beyond what they did in the financial crisis,
as Federal Reserve Chairman Jerome Powell announced a raft of stimulus measures unprecedented in their scale and magnitude. These including slashing interest rates near zero, as well as the dramatic ramping up of its controversial monetary policy known as quantitative easing, or QE for short. Effectively declaring it unlimited, QE involves the buying up of financial assets such as government bonds from the open market in order to increase liquidity in the financial system. We'll talk more about QE later. But the controversial aspect is that in order to get the money to purchase these assets, the Federal Reserve, with a few computer keystrokes, simply make it up out of thin air. A process commonly referred to as the printing of money, which has become a bit of an internet meme of late. With the promise of infinite money to backstop the financial system, the market's response was immediate. From the March 23rd low, the Dow Jones dramatically reversed course, regaining about 2/3 of its lost value in a matter of weeks. The Nasdaq fared even better. Not only did it regain all of its lost value, but it surpassed its all-time high. What had been one of the worst bear markets in history morphed into a raging bull market with a speed and intensity that took everyone by surprise, particularly as it was taking place amidst arguably the worst economic conditions since the Great Depression. What was even more surprising, however, was what was driving it. Whilst many institutional investors remained on the sidelines, doubting the recovery. For example, Warren Buffett took a heavy loss selling his entire stake in the airlines just as the markets began its recovery. It was retail investors and day traders who cashed in on the Fed's intervention the quickest. Empowered with new digital tools such as zero-fee trading apps like Robinhood, they piled into the markets in unprecedented numbers, buying up everything, including high-risk stocks of companies with high debt levels hardest hit by the crisis, such as cruise lines and, yes, the airlines. If this was a Pavlovian response by markets, these were simply the quickest and hungriest dogs in the pack. This set up tension between institutional investors, many of whom incurred early heavy losses, and this new breed of retail investor, more than happy to brag on social media about their wins. This is best exemplified by the Reddit community, Wall Street Bets, and most recently by the self-declared captain of day traders, Barstool Sports founder Dave Portnoy, who happily stoked these tensions by mocking institutional investors, who he refers to as the suits.
The pinstripe suits as the thing all rigged for their benefit.
Even going so far to call Warren Buffett washed up.
He's old and he's washed up. I'm the new breed. I'm the new
flood
generation.
of the Fed's money, combined with a tsunami of retail investors, compounded by algorithmic trading, which amplified market movements, pushed stock even higher. This created a severe disconnect between a Wall Street flying high on Fed stimulus and a Main Street in the depths of an economically debilitating lockdown, kept alive through a trickle of government handouts.
Cheers.
This disconnect was best captured in a screenshot that quickly went viral from an episode of Jim Cramer's CNBC TV show Mad Money, which aired on April 9th. For their part, retail investors were criticized in the media for their perceived naivety with regards to equity markets, accused of creating a euphoria that was pushing stock valuations up in the midst of a crisis. In other words, a bubble. But these criticisms ignored that there were more significant forces at play than simply market forces. Chief among them, generational forces, best exemplified by the growing tension between millennials who, under an increasing debt burden, are expected to shoulder the economic fallout of a baby boomer generation entering retirement. A generation that many see as selfish, who have lived through the golden age of capitalism, embarked upon an unsustainable fiscal and environmental path leveraged upon the future of those born after them. In this context, far from being part of the solution, the Federal Reserve is actually seen as part of the problem. The primary mechanism by which the burden of financial responsibility is deferred, passed down the line in an ever-expanding bubble of debt, a process commonly referred to as kicking the can down the road. To compound the issue, this loose approach to monetary policy in conjunction with injection of huge amounts of generated liquidity via QE has the direct effect of artificially inflating asset prices, a prime driver of inequality in society today. This is because the wealthy own most of these financial assets. For example, in the U.S., around 85% of all stocks are owned by the wealthiest 10%. So, it's only natural that they benefited most from the Fed's actions. In fact, while a lot of what's been taking place can be framed in terms of generational clash, it is, in the end, really about wealth inequality, an issue that transcends age. The generational component comes into play simply because the wealthiest in society tend to be older because they've had longer to accumulate that wealth. Further, many positions of power, for instance, the Federal Reserve Chair, are still occupied by baby boomers. As a result, the stock market crash of early 2020 was seen by many as a generational opportunity to storm the financial gates and take advantage of the collapse in asset prices, a rare opportunity to steal something back from a system that many see as being rigged against them. It's no coincidence that the most popular trading app being used today is called Robinhood, named after the mythical outlaw who robbed from the rich to give to the poor. And while some of the criticism leveled at this new breed of investors with regards to their naivety in relation to the markets and investing fundamentals may be justified, it does not apply to all. In fact, what the vanguard of this movement has been quick to realize is that due to escalating central bank interventionist policy in markets over the years, a policy that has been supercharged by the current crisis, the game has changed completely. As a result, it is naive to assume that what we have today are free and open markets where traditional fundamentals still apply. Instead, there's an increasing belief that we really don't have capitalism anymore. Certainly not the free market version of it. In its place, we now have something that more closely resembles, well, socialism. But a corporate version of it. One in which Wall Street and those with the ability to access to credit markets are subsidized by a central planning commission in the form of the central bank. Under this new system, the only fundamentals and investment advice one needs to understand are, number one, you don't fight the Fed. And number two, as long as the money printer goes, stocks only go up. But how did we get here? And how did things get so messed up? While some naturally point to the pandemic, others believe that this black swan event only exposed what was lurking beneath the surface anyway. Like the iceberg that ripped through the side of the Titanic, exposing the structurally weak iron it was constructed of. No. In order to truly understand, we need to take a trip into the past, because as they say, the past is prologue. But perhaps there's another saying that is more fitting.